Hi, I'm Megan Miller, an Associate Wealth Advisor at Towerpoint Wealth, a boutique wealth management firm here in Sacramento. Recently, our President Joseph Eschleman and I had the opportunity to present at the West Sacramento Real Estate Investor Meetup. It was great to see so many of you out there. If you missed it or would like to watch again, stay tuned for a full replay. Click the link in this video description if you'd like to schedule some time with us to chat about your unique real estate tax planning needs. We hope you enjoy this presentation.
All right, thanks so much, Sergey. Thanks for all your work and organizing all things. I know we all appreciate very much. Thanks everyone for having us here tonight. If I haven't had the opportunity to meet you yet, I'm Megan. I've been investing for almost 10 years now. I actually bought my first property in 2013 in June, so a couple months will be exactly 10 years from when I bought my first property. Since then, my husband Nicholas and I have acquired a variety of other mostly long-term residential rentals. We do have a fun glam site up the hill in the Tahoe area we've been playing around with, but most of our investment properties are those single-family or multi-family long-term residential rentals. I definitely remember being an intimidated newbie at these, but we just kept coming, and eventually we found all the connections and the confidence to do our first flip. And we did a couple of flips, and then kind of moved on and found what works for us and our investing. Also, over that time, the last a little over a decade, I've worked primarily in individual tax, helping largely high net worth clients tax plan, doing some other compliance tax return work. So it's really been a cool space to learn about that. Tax was actually why I got involved in real estate investing. Sitting in a tax class in college and learning about all the cool tax perks of investing in real estate compared to some other investments, and it really grabbed me and it just clicked. And 10 years ago, moved up to Sacramento from LA to buy my first property. And transitioning from purely the CPA world, last year I really loved the planning side and not so much the actual tax return prep side. So looking for a better place to help clients more holistically in a full picture planning, found Towerpoint Wealth. We're a fully independent financial planning and investment management firm, and I really connected with the values of the people of the firm and how they uniquely serve all of their clients. So with that being said, here to welcome my co-presenter and our president of Towerpoint Wealth, Joseph Eschleman, to kick it off.
Thank you, Megan. Appreciate it. Thank you all for being here tonight. And Sergey, I understand. How long has the organization here in West Sac been active? Due to you and your entrepreneurial spirit?
By West Sac Meetup, 5 years.
5 years. That's great. That's great. I know Megan's obviously, along with Nicholas, excited to be a part of this and obviously grow their real estate portfolio. And to see all these different individuals here tonight that have an active interest in obviously the net worth and wealth building opportunities that real estate provides is amazing. And at Towerpoint Wealth, we recognize in terms of how we help, our goal at Towerpoint, very quick commercial and move on, is to help our clients properly coordinate all of their financial affairs. Be that taxes, be that investments, be that real estate, be that estate planning, anything to do with money, we're hoping to work with them and kind of be the captain of the ship financially for all of our clients. And to be in this world that people have a great and acute interest in real estate is enjoyable. And again, we wouldn't be here tonight without you taking the time to organize the group. So again, credit to you, Sylvia. 2 quick jokes just to kick things off. I had to work hard to scour the internet for real estate jokes, so we'll see how these go over. If you owe the bank $100, that's your problem. If you owe the bank $300,000, that's the bank's problem. Maybe not so good with what's happened over the past 2 weeks, but I thought it was funny. How many real estate agents does it take to screw in a light bulb? It takes just one realtor to screw your quality LED bulb into the gold-plated chandelier hanging from your vaulted ceiling with crown moldings and skylights in your English too. They like to embellish. I appreciate the opportunity to be in front of everyone tonight and talk a little bit about the tax benefits, opportunities, ways to leverage this unique tax code that we have here in the United States. We work with a lot of clients that obviously have owned or do own and built their net worth and their wealth with regular stocks, bonds, mutual funds. Certainly a wonderful way to compound what you're doing to grow net worth. But at the same time, most of our clients at Towerpoint have significant exposure to real estate as well. And there are some unique tax opportunities that come along with real estate. So I think Megan will be happy to share a lot of those ideas along with myself. So Megan, with that, take it away, and why don't you highlight a couple of those initial ideas.
Great, thanks, Joe. So as it seems like almost everyone knows, we're here to talk about everyone's favorite topic, taxes, which will hopefully be a little less daunting and maybe even exciting in relation to some of your real estate investments by the end of tonight. So to keep it exciting as well, we're going to throw in some trivia for you guys and have a couple fun prizes. One being the Bigger Pockets published book on tax strategies for the savvy real estate investor, and a fun, environmentally friendly metal water bottle. So to kick it off, first trivia, where was the first meeting of this West Sacramento meetup held? Deb? Sal's Tacos, that is correct. I heard you already have this book, so we'll go with the water bottle.
Oh, do you want a Towerpoint Wealth beer stuff? Beer bottle. The water bottle or the beer glass? Ooh, nice hands.
Oh, you're throwing things. All right, we're getting real. How's the sound, sir?
It's an interactive presentation tonight.
All right, looks like we're a little off the screen. Thanks, Sergey. Kurt. All right, this is a quote actually out of this book here. In America, there are two tax systems, one for the informed and one for the uninformed. Both are legal. That is 100% true. If you don't know about it, you're probably paying too much tax. So tip number one here, start with the basics, more catered to our newbies here. But what does it mean to be able to deduct your business expenses for tax purposes? Just start a business. Do I mean set up an LLC, go through all that paperwork? No, not at all. There's a place to deduct your business expenses, report your business income on your individual tax return just fine. So what do you need to do here? Again, no entity setup necessary. Really just set up a separate business account and start to track those expenses that you're incurring. And we'll talk a little bit more about some of what those are. But set up a separate account and track those income and expenses that you're incurring. There's some great apps out there for your phones. By no means the QuickBooks advertisement, but this is one of the tried and true ones. Download it on your phone, take a picture of your receipt. It tracks your mileage. As you're going through it, kind of looks like a dating app. You swipe right for business, left for personal. It'll keep track of it and help you deduct that at the end of the year. And really the benefits here of starting a business, these are deductions that you can't take if you're just a W-2 employee. So this applies to real estate, any other side hustle. But really, you can start to deduct items like the business use of your car, cell phone, home office, things that you're probably paying already, but can now attribute partially to business and start to deduct. So a quick note here, kind of touched on it. You don't have to set up a business entity to make this happen, and I kind of am in line with this quote here from Thomas Jefferson, never spend your money before you have it. Entity setup is often expensive. California gets you for $800 a year on an LLC, except for first year, but after that, you're paying $800 just for the privilege of having that LLC in California. So really, if you're just starting, just get going. That's my advice. If you don't have a lot of assets to protect liability-wise, don't have a lot of income yet, just get going. Set up a separate bank account and start tracking those expenses. All right, quick trivia time. What two things should you do in order to consider your expenses for business deduction? There's a hint over here.
Get serious about it.
What'd you say?
Get serious about it.
Get serious about it. All right. What's your name? Christian.
Is it set up a separate business bank account and start your
Absolutely. How did you figure that one out? That's fantastic. All right, we'll give you
the book?
the book. Yeah, absolutely. We're going to trade off your prizes. A couple other items that might sound basic, but I know not everyone is aware, and even in my first tax class, didn't know the difference between a deduction and a credit. If someone says you want a $5,000 tax deduction or a credit, which one do you want? Right? So how do these work on your tax return? What's actually more beneficial? And when you're looking at an opportunity for a deduction or credit, how do you know which one to take? So deduction, if you're looking here at gross income, both sides the same, $100,000. A tax deduction is a reduction of your taxable income. So deduction reduces your taxable income. Say your tax rate is 20%, you're still paying $19,000 in tax. If you're getting a $5,000 tax credit, you don't get that deduction here. Your taxable income is higher. Your tax calculated is higher, but after this tax credit, your tax due is only $15,000. So hopefully that highlights all else being equal. If someone offers you a credit or deduction, you're going to take that credit, right? All right. All else being equal, which is more beneficial, tax deduction or tax credit? Credit. Credit. All right. All right, Paul first. Yeah, credit. We're offering, the solar credits, direct reduction of your tax. Business expense deductions. So in our real estate businesses, what are the common things that we can deduct? Advertising. Any of your mailers, anything that you're boosting posts, any of those advertising efforts. Vehicle usage, we'll get into that in a little bit more detail, but who knew they could deduct the mileage to drive here tonight? You can deduct your food and your drink here tonight, right? So that's something I think a lot of people miss is vehicle usage. Your laptops, your phones, or a portion of that. If you have a computer you use, half for work, half for personal. Insurance, office expense, and we'll talk about business meals and travel as well. Alright, so you're not supposed to be able to see this whole thing. This is just letting you know that if you don't have a business entity set up, this is the schedule on your tax return that you can deduct your business expenses and report your business income. So again, this would just mean you have a sole proprietorship, you don't have an LLC, you don't have an S corp, you don't have any of those things set up, and all of your business income and expenses just gets reported here. So this is for maybe our flippers, our wholesalers, contractors, lenders. If you don't have those entities set up, there's a perfectly good place on your individual tax return to deduct those expenses.
And Megan, you don't have to itemize in order to still take advantage of those?
No, this is completely separate from the itemized deduction, which is great because the itemized deduction or the standard deduction has gotten quite high. So if anyone's familiar with the mortgage interest deduction on your primary residence, that's subject to the itemized deductions. This is completely separate from that, which again is a great reason to start a business. If you're an employee, those expenses are limited also on the itemized deductions for those of you who are familiar with those. This is kind of a lot, but it's really just to let you know that Schedule C, it lists out everything you can deduct. And just to give you guys some resources and places to research this on your own after our presentation today, the IRS gives a nice instructions for Schedule C. It says exactly what you can deduct. You're looking for what is a business meal expense. A meal that's ordinary necessary in your course of business. If you typically take out clients or prospective homeowners, that's absolutely deductible if it's ordinary in the course of your business. Some things here, car and truck expenses. The IRS says you can try and track each individual expense you spend on your car or truck, or they have a cool standard mileage rate. So really, you use that app, your QuickBooks app, you're swiping right for the business mileage. At the end of the year, it'll tell you how many miles you drove, and if you give that information to your tax preparer, they'll say that mileage times, it's about 60 cents per mile. So if you're driving out to your investment properties quite a bit, and you're coming to all these, pre-end meetups twice a week, track that mileage. It adds up quickly at 60, 65 cents a mile. If you're going to scope out neighborhoods or properties, attend open houses, again, come to these meetups, that's all deductible. Your food here tonight, and also we'll get into travel in a second too. Thanks, Sergey. So along with business expense deductions, vacation smarter. So if you want to go down to LA, take your family to Universal Studios, and go to the beach, how do you make that trip deductible? Make it a business trip. And how do you do that? So if at least 50% of the days of your travel, and travel days are considered business days, if more than 50% of the days of your trip are business days, all the airfare, all the transportation, all your accommodation expenses are fully deductible, and all your meals are deductible at 50%. So what does that look like? If you want to go down to LA for the weekend, and you have to do this proactively, you can't just go down there and wing it and then see a property or two and call it a business trip. You need to proactively plan. But say you want to go down for the weekend, so Thursday is your travel day, You find a real estate conference ahead of time on a Friday, you book that. Saturday, hang out at the beach. Sunday, take your family to Universal Studios. Monday, you have an appointment to view investment properties. And Tuesday, you travel home. So of those 6 days, 4 were technically business because those 2 travel days count as business. 2 were personal days. So it's more than 50% of your trip was business. You can deduct the entire amount of travel expense, your flight, your drive down, however you got there, and all of your night stay. Again, not meant to see this whole thing, but if you are a sole proprietor, you don't have another business set up, and your business is primarily rental properties, Airbnb, short-term or long-term rental properties. This is Schedule E. There's a place on your individual tax return. You can report those. If you don't need a separate entity, you can take care of those on your individual return. All right, trivia time. What percentage of your trip days needs to be business? What percentage? Julia? At least 50% of your days have to be business to deduct the entire.
Which one?
Yeah, let's not do this. Okay, this is something cool that came around with the 2017 Tax Cuts and Jobs Act, QBI, Qualified Business Income. What the hell is that? Excuse my language. Any income that you're earning from sole proprietorship, and even from S Corp partnerships, considered small business income. And in order to incentivize small business, the IRS said for at least 5 years, at least 7 years to the end of 2025, we're going to allow you to basically take a 20% haircut off the top of that income and only pay tax on the remaining 80%. So this does not apply to capital gain income. It does not apply to W-2 income. It only applies to business income. So start those businesses. Track it. Okay, one more for you guys. What's one type of income that does not qualify for that 20%? What's that? Julia just got it. In the back, what's your name? Yes? Capital gains, yes. Thanks, Ray. Okay, this is a cool strategy called a family business strategy. And no, you don't have to go into business, start a business with your family. The goal here is to shift income within your immediate family from higher income tax brackets to lower income tax brackets. And how does that work? So our family equation over here, if you have one high school kid plus a middle school kid, if you have them each working for your business 10 hours a week, let's skip ahead real quick. So what does that look like? How do your kids, actually work for your business and actually help you in a helpful way? Younger kids, they can get in your office and help shred, file, organize. They're great at labeling. They're great at stuffing envelopes for any sending out with mailers. Older kids, you can have them help with social media, go to your rentals, help with those smaller repairs, landscaping, your realtor, put out your signs. And these are all things that they can do. And no, they don't have to do 16. But really, it's just recording those hours. And this is likely money that you're paying them anyways, an allowance, or that's $20 dinners here and there for frequently that they're asking for money for. And here, if they're just working 10 hours a week at $15 an hour, that's almost $16,000 of deduction for you. So what that does is if you're in the 32% tax bracket, which is not even the highest tax bracket, it shifts that income from your 32% bracket down to their 10% bracket because they're now reporting that income on their tax return. And this works well because it's likely income that you're giving them in terms of maybe allowance or money for meals out or clothes or whatever that they can earn. Again, track it, record it, one second. And in this example, that's a $3,600 tax savings. And you're over here saying $8,000 a kid a year, that's a lot of money to give my kid. Maybe give them half and have them put that other half in a Roth IRA, which is kind of an even bigger bang for your buck. Because it kind of feels like you're deducting money that you're putting into a Roth IRA, which is traditionally non-deductible. Steph?
I was actually thinking about this because my elder son is going to go to high school next year. And so, how much shall I, or pay him so that he doesn't have to report on pay no tax. So that way I can just break it down, say he can earn only, for example, he can earn 7,800 for a year and he doesn't have to report because that's the limit and he doesn't have to pay any taxes. Then I can just back it off, 7,800 divided by 12 and that's his monthly whatever.
The answer, as usually is with taxes, it depends on your individual situation. If they're dependents, their standard deduction is a lot lower. It's only about $1,100, so anything above $1,100 in earned income, they're going to have to report. But the 10% bracket is up to $10,000–$15,000. We can chat later on your specifics. It'll depend on exactly what you're paying them and their situation, if they're dependent or not. Yeah.
That goes for
Sure.
And that goes for essentially not just a family member, but like in-laws that are staying with you, or possibly that weird cousin who you never really met who you're supporting in any way.
Absolutely, that's a great way to structure those deals. And I actually meant to mention it can go upward too. To if you have parents living at home who are retired and they might be helping you with your business anyways, or you want them to help with their business. This is again a great way to kind of to funnel that income in. If they are already in the lower bracket, so if they're retired or sounds like not maybe earning that much income on their own, and they're in a lower tax bracket, that's a great way to shift that income from money you might be paying anyways that you can now tax. Okay, I know we just threw a lot at you. We'll take a breather for a second. I know we got some questions answered. Does anyone else have questions at this moment? Beer?
I have a question on deducting miles. So could you deduct all your miles if you have advertising on your car? Like all your miles throughout the whole year. So if you have decals on your car advertising your services, could you deduct that from the day you put it on?
My gut would say, unfortunately, no. I would think the cost of putting all of that on, and then if you're only driving that car for business and you have a separate personal car, then yeah. But it would depend on the miles that you're driving. There maybe dive into this more and look at see if there's any case law on this. But I think if you're driving two personal events, that maybe just the price of the advertising.
You technically still advertise your business anytime you're driving.
As you're driving?
Yeah.
Again, it depends. You can probably get into that funding case for another way. I don't think that's a black and white one. Something like that. Alright, anyone else? Deb?
So regarding if you purchase a car, in order to get a deduction for the car for business use, is it better to lease it or finance?
Better to lease or finance depends on the payment amounts, how long you have it for. So again, sorry, it depends.
So either one we can use it for business deduction, whether we lease or finance?
So you can either take the business mileage deduction or you can deduct your actual expenses. So the actual expenses are more to track, more to figure out, or you can take the mileage. So you can compare those two. If your actual expenses are higher than the mileage, yeah, I recommend taking that. If you have a newer car, high lease payment, high finance payment, yeah.
I'm not sure, back to those family employees that we have.
Sure.
Are they, not to be too brief, but are they eligible for the employee retention credit?
Were they employees during COVID? Yeah, potentially. Again, it depends. We have to talk about your exact scenario, but
Talk to Megan offline.
yes. Don't want to give any blanket statements out here. All right. This is actually my favorite, and the reason I got into residential, rental, real estate investments, the double dip. So at a high level, this kind of feels like you're deducting your mortgage twice. And what it is it's because you can deduct your mortgage interest that you pay. So part of your monthly mortgage payment is interest, a large part of it, for the first 3, 5, even up to 10 years. And you can also deduct depreciation. So basically the IRS says you can deduct the purchase price of the home over a certain number of years in addition to the interest. So for a primary residence you're living in, you can only deduct the interest. For an investment property, you can deduct the interest and what's called its depreciation. And let's see what that looks like. So real quick, here we can look at some actual numbers. If your purchase price, this is an investment property. The purchase price of the home is $500,000. The IRS says that the useful life of the home. So, say if you have a phone or a computer, the useful life makes more sense than talking about those things. Maybe the useful life of your computer is 5 years before you have to get a new one and it breaks. Homes, I think, we feel like they last forever and are forever rehabable and livable. The IRS says the useful life of a home is 27.5 years. Why 27.5? I don't know. The IRS likes to make things difficult. It'd be nice if it was an even 30 years, but it's not. So the useful life of your home is how long you can break up that $500,000. So $500,000 purchase price divided by the 27.5 years of useful life is an annual depreciation of $18,000. Now, are you actually paying that money out of pocket? You're not. You're just paying your mortgage payment. So how that looks here, for those of you who might not know, a large chunk of your mortgage payment the first 5 or 10 years is interest. So it's not equal interest principal. Maybe 80 to 90% of that payment is often interest in those early years. So cash flow, let's say we're lucky, we're getting 1% roll on this, we're bringing in $50,000 of gross rental income. On the cash flow side, so the cash flow is what you're actually putting in your pocket, what you have to spend. What's coming out of that is your mortgage payment. So just your principal and interest we have here. And then other rental expenses grossly estimated right here, say it's $10,000. And what comes in your pocket is this $14,000 down here. But on the tax return side, say $50,000 coming in, you can deduct your mortgage interest. So of this, say $26,000 mortgage payment, about $20,000 that might be interest in the first, 5 or 10 years. Same rental expenses here, and you get this bonus tax depreciation. So again, this isn't money coming out of your pocket, and this is the taxable income on your tax return. So that's cool. That's what I saw in that tax class. That's why I'm like, hey, I need to, start investing in real estate. You can't deduct the price of your stock. You can't deduct the price of other investments. This is really cool.
Megan, is that depreciation, is that applicable, is that phased out depending on what someone's earned income is?
Depreciation phased out, it is not.
So regardless if I make $500,000 or $1 million a year, let's say, I'm still able to take that deduction, not credit, but deduction.
Absolutely. So big commercial property, you're making a couple $1 million a year on that, depreciation is still the same. Yeah.
Cool.
Any questions on that piece? Yeah.
At which point, if the depreciation or if your deductions get below or really close to your income, at which point do you start getting into trouble?
What do you mean getting into trouble?
So I know that you can, from what I've heard at least, that if you're showing losses for, X amount of years or whatever, then, they start looking at you more and going, oh, okay, something's a little weird here.
I think you might be talking about the hobby loss rules. If you have a business running a loss more than 3 out of the last 5 years, the IRS starts to question that.
Right. Is that
again,
the situation with real estate, or with real estate, I
haven't seen that as a major audit. And again, usually there's some cash flow, it's just kind of low. Again, I haven't seen this big audit trigger as much as just strictly hobbies like fishing or something you're trying to say you're doing for profit.
Okay, so for example, like if somebody has a house and let's say they rent it out on Airbnb, like a couple rooms, right? Or like let's say half the house. Let's say they have 2 stories and the bottom floor they rent it out for 3 months, right? Where they're able to rent it out for, let's say 3 months. Would they still be able to take the full depreciation for the house or half the house, and obviously that would be more than the 3 months that they made. So would that start to look suspect, or?
Basically it's prorated. So you take if they're renting out 2 rooms, it's a 4-bedroom house, so maybe you're taking half the depreciation, and then maybe you're taking it for only those 3 months out of the year. So it's all prorated there.
So you'd have to prorate it for the time that you rent it out, basically.
Essentially.
Okay, got it.
Yeah,
selling a house, seller finance, so essentially kind of like a contract for deed. Is that treated similarly to having a renter in the house because the title hasn't transferred to the new buyer possibly until the final payment of that agreement is made?
Generally, you want to look at who's actually paying those expenses, and whoever's paying the expenses is usually who it's deductible to. That,
That makes sense.
do you want to clarify if I can answer that?
Yeah, I think so. Yeah, I think so. I'll let you know.
Last chance. Alright, this one's a favorite for your flippers. It's called the long game. And this is how to minimize or completely get rid of any gain on the sale of your flip. This is called the primary residence gain exclusion. So if you find a great house you want to flip, it needs a lot of work, you have a couple years, you want to live into it, you can buy that property as your primary residence. And as long as you live in it for 2 of the last 5 years, as a single person, you can exclude up to $250,000 of gain on that sale. And for taxpayers filing jointly, up to $500,000 on that sale. So how that looks, if you're not familiar with a traditional flip, typically an investment property, one, you have to put at least 20% down. The primary residence you can get into for as little as 0%, usually 3.5 to 5% down. In an investment property, often flippers holding less for a year, holding for less than a year, and the gain is subject to your ordinary income tax rate. And your ordinary rate is those rates all the way up to 37%. So how that works for the primary residence. Obviously, you have to live in it for at least 2 years, and it has to make sense, big picture with the market and rates and sellability. You living there for 2 years, that has to all make sense too. But from a purely tax perspective, if you live in the house for 2 of the last 5 years, fix it up slowly and sell it, you can exclude up to $250,000 for a single person and $500,000 for a married couple. So if you're flipping, it might be worth sitting in one of those properties for a little longer to exclude a solid chunk of that gain. Another cool note on primary residence, in terms of your cash-on-cash ROI or return on investment, when you purchase a property as a primary residence, like I mentioned, you can put as low as 0% for VA loans, 3.5% for FHA, there's 5% conventional loans out there. And as long as you intend to or live in the house for at least a year, that's completely legit by the lender. And you can move out after that point. So this is a cool strategy, maybe if you're new or light on cash, to move into a property for at least a year and then move out and use that as a rental property. So instead of having to come up with that 20%, if you're willing to live in it for a year, that's a great way to use your property. Low down payments. Also, is a high return on investment rental. This is one example. Nicholas and I bought a house in Oak Park for $95,000. I wish we would have bought 6 more of those. The down payment, we put 5% down, is about $5,000. It currently cash flows about $400 a month. So the annual cash flow is about $4,800, which is a 96% cash-on-cash ROI. And how do we get that? So the down payment was $5,000. We put down 5%, and it's returning $4,800 annually. So not a lot of stock investments, although there are plenty of great ones out there, great to be diversified. But from a purely cash-on-cash ROI perspective, living in a house for a year, putting 5% down, moving out can give you a great ROI.
Megan?
Yeah.
What's the general difference in interest rate if I want to borrow money to buy as a primary residence versus a rental? And how does that tie into it?
Yeah, that's a great point too. The interest rate is usually slightly lower for a primary residence than it is for investment property. Estate planning is too. I want to also honor your time, so I'm going to get through some of this a little bit quicker. Estate planning, if you pass a property through inheritance, that can be a way to completely eliminate capital gains, which is great. So if you're planning for yourself downward or your parents down to you, it is a million times better to inherit that property than have your parents gift that to you. Because basically they gift it, their cost basis is your cost basis. If you inherit it, your cost basis is the step-up basis. Your new basis becomes the fair market value at the date of death. So if you were to turn around and sell that property, say, right after they passed, you inherit it, you're not paying any tax because there's no gain because your basis becomes the value at the date of death. If they gift it to you, as you can see here, that has appreciated to $500,000, your taxable gain is $400, pretty much immediately putting in the max tax bracket at 37% there. So if you want to take home $500,000 instead of $250,000, then definitely recommend having your parents pass that on. Through not through gifting, through inheritance, through their estate. Cost segregation, I'm going to cover this pretty quick. This is more of an advanced strategy for those serial investors out there who have super large properties or a lot basically super large commercial properties is great for. Basically break down the depreciation expense into its parts, trying to lower the average number of years, and with a goal of having a higher current year depreciation tax expense. And it's more advanced because you're required to have a professional firm do it, and so you have to outweigh the cost benefit there. All right, so I'm gonna hand it over to Joe here. This is something else. This is another quote that I found really impactful and quite encouraging in this book. That these two CPAs say that looking back on all of their truly successful clients, most were either real estate investors or business owners, and much of the time they were both. And I, really believe the business owner investor space is an excellent, if not the best way to do it. All right, a couple last trivias before I hand it over to Joe. First one, how long do you have to live in a primary residence in order to be able to deduct that $250,000 or $500,000? Kevin, 2 years. 2 out of the last 5 years. All right, one more. This is getting back to QBI. Who remembers what portion of your small business income may be eligible for the qualified business income deduction? Back. What's your name? Angel.
20%.
20%, absolutely. Whatever. Cool, all right, take a quick question break. Any questions on that? And then I'll let Joe take on a few more advanced strategies.
I got a question about, like you were talking about inheritance and gifts. How does it work if the property is in a trust and it just transfers over? I mean, how does that tax-wise work?
If it's in a trust set to, pass and transfer upon death, that's probably set up correctly.
I mean, sorry. So is it?
It depends on how the trust is written.
Okay.
So the trust dictates how the
So
property
is
is
it
passed.
beneficial to have the property in a trust before they die, tax-wise? I mean, is it still?
It doesn't necessarily have to be in a trust before they die, as long as it passes through inheritance. But I think generally having property in trust is a smart idea.
Can you gift the property? But can you have the property in the trust and gift it before you pass without paying taxes? I don't know.
There are some complex trusts that potentially yes, but
I mean, is that a good way to try to avoid the gift tax prior instead of trying to wait for the inheritance?
it depends on how big the estate is of the people passing it, how big the estate is of the people inheriting it, and how much you want to spend to set up the trust to do that.
Thank you. Sorry for
Yeah.
not being so clear at first.
No problem. We're here for it. Hi, Joe. Shut up, you take care.
Thank you, appreciate it. Does everyone have a handout? I asked for a few reasons. Number one, while we don't have it physically here, we do have a pretty cool giveaway of a Ring doorbell. I don't have one myself, but I rang them multiple times. And we try to be proactive at Towerpoint on social media. We're active on Facebook and LinkedIn, and probably over the past 6 months or so, we've had a lot of clients and friends of the firm call us a good follow, whatever that means. But we try to post timely content and value. And if you follow us on on Instagram, we will enter you into a drawing to win a free Ring doorbell. So I'm going to try to provide a little bit of value there, and also build our follower base. And I think if you follow us, you'll definitely get some benefit out of the content that we post on a regular basis. So it's at TWRPOINT wealth.com. Number two is we do have a link tree that if you scan the QR code, there are some different resources that are available for everyone here this evening. So take a little bit of time at some point tonight to make sure you check out that as well. It's not too tough now to scan those QR codes like it was 2 years ago. So Megan, awesome job, tons of opportunities for tax saving, tax credit, which we like more than deductions, but deductions are still cool. And it basically sounds to me as if it's important that if we're going to be a real estate investor to get more serious about it and treat it as a business And if you do so and do some proactive planning, that there are a lot of tax opportunities to be had. So I think that's wonderful content. What I'm going to talk about this evening, not for too long because I'm going to be somewhat assumptive that most of the individuals in the crowd tonight are aware of what's called the Section 1031 exchange. This is where stock, bond, mutual fund people get a little bit jealous of real estate investors because we, as a stock, bond, mutual fund investor, are not able to sell a stock, bond, and mutual fund and take the money and reinvest in a new one without paying either short-term or long-term capital gains, assuming that there was a capital gain. But with Section 1031 of the IRS Code, there is an unbelievable opportunity to continue to build and compound wealth, keep the IRS out of it completely if you follow a bunch of rules, and take advantage of deferring capital gains taxes, assuming that they're happening in your real estate investing, potentially over your lifespan. And so a lot of people and a lot of real estate investors out there are familiar with Section 1031, where basically what you need to do is if you have an investment property, you want to sell the investment property, you can. Once the transaction closes, you are not allowed to take possession of the money. And with a 1031, you have to then send the money or have the money wired or transferred to what's called a qualified intermediary, or QI. They are basically an escrow agent that will hold that money in escrow until you, as a real estate investor, identify a new property to invest in. And if you check all the boxes, dot all the I's, cross all the T's, you are then able to defer any type of capital gain that you enjoyed or reaped the benefit of from that initial property, and have the QI then transfer the money over to the escrow agent and the title company for your new investment property. So what I'm going to talk about tonight isn't so much the more standard or traditional way of doing a 1031 exchange. And what I mean by traditional is most people or most investors, they love the idea of the 1031 because they don't have to pay a dime of income tax if you do it right. But sometimes it can be challenging to identify a new property and ultimately close on a new property. And so there's some pros and there's some cons to taking a physical piece of investment property, selling it, and then finding a new one. And what we at Towerpoint Wealth work to help our clients better understand is if you're going to entertain buying a new physical property, what is the return on investment, or Megan referred to earlier, the ROI of that investment property? Is that good? Is that beneficial? And or are there other alternatives that are what we call 1031able, that meets the criteria of the IRS code to defer that capital gain, again, as long as you follow the rules. So with the traditional 1031, again, one of the things that you have to do is give that money, or transfer, I should say, that money to the qualified intermediary, and then you have 45 days, so a month and a half, and you have to identify a new piece of investment property within that time. Once you've identified the property that you want to buy or invest in, you then have 180 days after that to actually close on that new piece of physical property. That's great. However, what we've seen at Towerpoint and working with a lot of our clients is they'll own a piece of property, they've had a tenant in that property for 2, 3, 5, 10 plus years, and they're charging the tenant the same rent that they charged them 5 or 10 years ago because they like the tenant's easy, it's inertia, whatever the case might be, which is all fine and dandy. But once you take into account the fact that that rent hasn't been increased, along with some of the costs and expenses associated with owning an investment property, taxes, obviously insurance costs, maintenance, etc., that can eat into the overall return of the property, obviously excluding hopefully the increase in value. So not suggesting that when you do a 1031, that you shouldn't consider buying a new piece of physical property. Totally a wonderful option, as long as you're doing the math and the ROI makes sense on the new property. You'd be surprised how many people don't do the math on these things. There's a different alternative that is available to real estate investors that is not a piece of physical property, but instead is what is known as a Delaware Statutory Trust. Fancy phrase, DST for short. Us wealth management and investment people like our acronyms. And so different option or a different alternative, instead of buying a piece of physical property in that 1031 exchange, is to invest in a DST. And what a Delaware Statutory Trust is basically a fractional ownership of a large piece of commercial real estate. It can be a 10, 25, 50, $100 million strip mall, or office building, or student housing, you name it. Anything that falls within the commercial real estate space can basically be wrapped into this structure known as a DST, still allowing you as a real estate investor to follow the rules, take full advantage of the 1031, don't pay a dime of income taxes by doing that transfer properly, but instead of owning individual property, you then have exposure to basically a piece of commercial real estate instead of the individual property. There's some pros and there's some cons to this. And one of the major pros that we've seen in dealing with a lot of real estate investors, again, or at least those investors that aren't running what we call an ROI analysis. Mr. Jones, Mr. Smith, you've had your tenant in here for 15 years, haven't raised the rent after taxes and insurance and other costs. Your ROI on this property is 2.5%. Are we happy with that? Is that good? Is it 5%? Maybe we are, maybe we're not. But if that ROI is low, a lot of times you're looking at a piece of commercial property, not only do you get the opportunity to graduate, is a decent word to use, which I think a lot of people in this group tonight are looking to continue to kind of move along that real estate investing curve, from owning local pieces of investment property just in the greater Sacramento and Northern California area, and have the opportunity to get geographic diversification, where a DST can own or invest in a warehouse or a strip mall or student housing or what have you in Maine or Ohio or Florida, and get you geographic diversification as well as have exposure to commercial instead of residential. I also use Towerpoint Wealth as an example. We signed a lease at the Bank of the West building on Capitol Mall, or at 500 Capitol Mall. Love being there. It's primetime real estate, which is not cheap, and it is a 6-year lease that we signed, and inside that lease, which is very traditional and normal for commercial real estate, we have rent escalators automatically built into the lease that we signed at Towerpoint. So put differently, every year we're paying more and more in rent until that lease expires. As an investor in a DST, you automatically would reap the benefit of a higher monthly income payment to you as a fractional owner of that DST, primarily because of the fact that those rent escalators are built into obviously the terms of the lease that most commercial real estate deals are signed to. So I think that's very important. Another thing that is a consideration for real estate investors is liability. And I've owned investment properties and investment real estate here in the greater Sacramento area for about 10 years now, and it's wonderful. It's been a tremendous way to build net worth, obviously, as real estate has grown. But inherently, if you've got Mrs. Jones or Mr. and Mrs. Smith and their kids, and they're living in a property, there's inherent liability associated with that. By owning a fractional share of a DST, you've really diversified that liability, over 500, 600, 700, maybe even 1,000 different owners who all own, 0.5% or 1% of a $50 million property. And it doesn't completely absolve you of any potential issues, but the DST is professionally managed, so you don't have to worry about managing it whatsoever. You just simply sit there and collect your monthly check and have the opportunity to diversify away some of that liability as well. So Section 1031 is an unbelievable way for a lot of real estate investors to compound tax-free, which is a phrase we don't often get to use, your wealth. And we're not suggesting that buying another property is bad or good, or this new idea I'm introducing to you tonight, that being a DST, is better or worse. But it is important, and we do think it behooves investors to simply understand that there are various options out there, just like any investment, with their pros and with their cons. But the more you know, the more you're educated about what these different opportunities are, ultimately you're going to be a smarter and better investor and hopefully grow your net worth much more quickly. So, please.
So, are you able to then sell that and buy another investment property such as residential property and do the 1031 exchange again?
Yes. So I hesitate when I say yes because with a DST, the one I would say a drawback of a Delaware statutory trust is from a liquidity standpoint. Meaning you own a piece of regular investment real estate, you control when you buy and sell your house or the investment property. With a DST, the professional management of the DST, the intent of the DST is to own the warehouse, to own the student housing, to own the strip mall, and have it go full cycle, which means they sell it, which can be anywhere from 3, 4, 5, 6, 7, 8, 9 years.
Do they usually have that planned out ahead of time, or
it depends on? I mean, that's the goal. That's the intent. Is if you own a fractional share of a DST, odds are you're not going to own that fractional share forever because the professional management is ultimately looking to improve the property and sell it when the market's good or correct and make improvements along the way. But at the point where the DST goes full cycle, they decide they want to sell the property, you as the fractional owner then have the choice to say, give me my money in cash and then pay the capital gain based on your original basis of your original investment of your first investment property before you did the 1031, or to do another 1031 at that particular point, go buy a property here in West Sacramento or Roseville, or go buy another interest in another DST somewhere across the country. And these DSTs are, they've been around for 50 years, but the popularity has really increased probably over the past 7, 8, 9, 10 years, where it's a multi-billion-dollar industry.
So you can't really sell your interest in it. You have to wait for the cycle for them to sell it.
That is correct. And I think that's part of the reason why generally the yield and ROI of the DST tends to be a little bit more attractive than a regular piece of investment real estate, is because they have what's called a liquidity premium, not to use big fancy words, but because it's a semi-illiquid asset where you don't really have control of an owner as far as selling your share until the property itself held inside the DST is ultimately sold.
Okay, and last question on this. Is it usually that they buy and sounds like flip it, or is it for developments as well, where they build a brand new structure, for example?
No, they're not building a brand new structure. Usually the intent is to buy, I don't know if I'm going to call it distressed property, but they're just looking to buy something they think is attractive as a whole, and then ultimately to make some improvements. Take advantage of the economies of scale that, these multi-million-dollar deals are able to take advantage of. Hopefully have some price appreciation, reap the benefits of the improvements, and sell the property 4, 5, 6, 7 years. Not unlike, a piece of, regular residential investment, I would say.
It's kind of flipping, but on a larger scale.
And you don't control it. Ultimately, the sponsor of the DST controls when that commercial property is sold.
Okay.
Yeah, good questions, yeah.
Quick follow-up on that. What's the difference between a DST and a syndication? Or can DST be part of the syndication?
Yeah, I think they're equitable, right? With a DST, you've got $50 million property. Usually the minimums on a DST are $100,000, $250,000. Some of them are $1 million. So, another key point is you have to be what's called an accredited investor in order to invest in a DST. Meaning you have to have at least a net worth of $1 million. Or at least an income of $250,000 in order to buy that. But in terms of the definition of what a syndicate is just a group of people that are together to ultimately accomplish a joint goal. And this is an investment goal, so in that case, it's fair to classify a DST as an investment syndicate.
It's just a type of
Yeah, I mean, it's like in weird ways, kind of like a mutual fund where there's a bunch of shareholders, except, typically there's just, that particular property that's encased or housed in this structure. Yep, absolutely. So I'll happy to hang around after the show. I'll take one more question, and then I've got a few other things, and I'm going to wrap it up. But yeah, please, one more.
Anybody want, as far as I understood so far, was I can use, if I sell a restaurant, I buy a like-minded property meaning on the restaurant. If I sell a hotel, I buy a hotel. It should be the same value or a higher value or a bigger property. Does DST qualify as like-minded?
It does. Yeah, I mean, if you sell a restaurant, you don't have to buy another restaurant. It just has to be the same, same or higher price point.
You can buy a restaurant?
No. You can sell a restaurant and buy a warehouse. You can sell a restaurant and buy an investment property. Yeah.
It doesn't have to be investment. Just has to be investment real estate to investment real estate. No personal vacation, just investment real property to investment real property.
So DST qualifies as?
You betcha. So, interesting, powerful, different than what we've seen most of our clients who own and have built net worth in real estate. And that's part of the reason why we work to make sure we educate them about, what the heck these things are, what are the pros, what are the cons, and, they're not right for everybody, and just like any other investment products, things make sure you consider, but that's what keeps firms like Towerpoint Wealth in business.
If you hold property in a trust and then you return 41 into a DST, is that still safe in trust?
Yeah, I mean, if you have a property titled in a revocable trust or traditional revocable trust, yeah, you would own your interest in the DST titled in the revocable trust. Yep, you bet. So lastly, and this is the thing that got me as Megan and I were working together, 80% of the credit goes to Megan as far as the presentation is concerned. And you heard me ask her a couple questions here offline about the fact that when you're a real estate investor, as I think most of the people in this room are, as a sole proprietor, we're not starting an LLC. We're not doing an S corp. We're not starting or paying money to open up a business per se, but it's just simply filing Schedule C, right? That there are tax opportunities and net worth building opportunities specific to being a sole proprietor. And what I mean by that is anyone who is making and earning money, thank you, sir, I'll get this one better, has the ability to open retirement accounts, fund a retirement account, and not a tax credit, they gain a very, very attractive tax deduction dollar for dollar with the three types of retirement accounts I'll talk about briefly this evening in order to better, let's not throw the baby out with the bathwater, build net worth, and, oh, by the way, save a boatload of money in income taxes. So what I mean by that is if you're an individual investor, you're a sole proprietor doing your thing as far as investing in real estate, you then have the ability to open and fund, number one, what is called a SEP IRA, or Simplified Employee Pension is what a SEP means. And basically a SEP IRA is a type of very easy to open and administer retirement account. And dollar for dollar, the amount of money that you put into a SEP IRA, again, broken record, dollar for dollar, you then can deduct off of your ordinary income on the tax return. So you have the ability to put the money in, let it grow tax deferred inside the SEP, just like a 401k or a regular IRA account, and then when you take the money out, you do have to pay income taxes in the future, but you've got all that compounding working for you in the meantime, as well as the tax deduction that it offers. Limit on that, $66,000 for 2023, and I would say is somewhat, I don't know if problematic is the right word to use, but the important issue is you're capped at 25% of your earnings or profit as a sole proprietor in terms of what you can do or fund into a SEP IRA. it's certainly a very powerful tool. Limits are much, if you're a W-2 employee working for a company, most you can put into a 401k plan is 22.5, yeah, I should know the numbers offhand. Versus a SEP, you've got a heck of a lot more bang for your buck, so that's very important. Number two, as an alternative, a comparable alternative with two differences to a SEP, is you have the ability or option to open a solo 401k. With a solo 401k, the limit of $66,000 is still the same, but the two differences with a solo 401k is you're not capped at 25% of compensation. You can put into up to 100% of your comp into the solo 401k. So if you're not making, $300,000, or 25% of that, I'm sure my math's not 100% correct, is $66,000. You can fund a